All right, if you're planning for retirement or even just thinking about it, you need to listen up. There is a nasty hidden tax out there that can absolutely wreck your budget, costing you thousands of dollars a year. It's called IRMAA, and today we're going to pull back the curtain and show you exactly how to defeat it.
I want you to imagine this for a second. You did it. You retired. You're waiting for that very first Social Security check to hit your bank account. But when it does, it's way, way smaller than you thought. Hundreds of dollars are just gone. And you're thinking, wait, what happened? Was there a mistake? Nope, it's not a mistake. For millions of retirees, it is a massive, unwelcome surprise.
So what is this thing? This silent wealth killer that can just reach into your Social Security and take a huge bite before you even see it? Well, it's a stealth tax that, frankly, punishes people who did everything right. And it goes by the name IRMAA.
Okay, so IRMAA stands for Income-Related Monthly Adjustment Amount. It's basically an extra charge, a surcharge, that you have to pay for Medicare Part B and Part D if your income is over a certain limit. But here is the real kicker. This is the part that trips up everybody. It's not based on your income today. It's based on your tax return from 2 years ago. Think about that. The money you earned back in 2023 when you were probably still working full-time is what sets your Medicare premiums for 2025. See the problem? It's a huge disconnect, and it's how so many people get ambushed right at the start of retirement.
So let's dig into why so many financial pros call IRMAA a stealth tax. It's because it's hiding in plain sight, and for people who've saved hard their whole lives, the financial hit can be absolutely staggering.
Just look at this difference. It's kind of nuts. For 2025, the standard premium for Medicare Part B is about $185 a month. Manageable, right? But if your income from 2 years ago pushes you into the highest bracket, you're paying $628.90 every single month. That's over $440 extra just vanished from your Social Security check before it even gets to you.
Now, you might be thinking, okay, that's just for the super wealthy, that won't affect me. Well, not so fast. Right now, only about 7% of people on Medicare pay it, but that number is set to explode. Why? Because you have millions of baby boomers who are now retiring with really healthy 401ks and pensions, and they have no idea they're about to walk right into this trap.
And if you thought that was bad, well, it gets worse. This is probably the most dangerous part of IRMAA. I call it the income cliff trap. This is where a tiny, almost laughable amount of income can end up costing you a fortune.
You see, the way the IRMAA brackets work, they aren't a gentle slope. It's not like your premium goes up a little bit for every dollar you earn. Oh no, it is a hard, sharp cliff. If your income goes over the line by just one single dollar, boom, you fall off the cliff and land in the next, much more expensive tier for the entire year. No wiggle room.
Let me show you how brutal this is. Look at this example for a married couple. If they have an income of $211,999, they're fine. They pay the standard premium. But if their income is just $2 more, $212,001, that $2 triggers almost $2,000 in extra Medicare premiums for the year. A $2 mistake costs them $2,000. It's absolutely insane. So what income are they even looking at? It's something called your Modified Adjusted Gross Income, or MAGI, and it includes all the stuff you'd expect, right? Wages, your pension, any money you pull from your IRA. It also includes capital gains and taxable Social Security. But here's the real trap, the one that gets so many savvy savers. It also includes tax-exempt interest. You know, from things like municipal bonds. So many retirees load up on these thinking they're being smart about taxes, without realizing that tax-free income is pushing them right over an IRMAA cliff. All of a sudden, your tax-free income is anything but.
Okay, I know that was a lot of doom and gloom, but here's where we turn the corner. This is the good news. You are not a helpless victim here. You can take control. With smart planning, you can absolutely manage this thing. So let's talk about the strategies you can use to beat IRMAA.
Think of this as your anti-IRMAA playbook. We've got some really powerful tools in our arsenal. We're talking about things like Roth conversions to build a bucket of tax-free money for later, using qualified charitable distributions from your IRA if you give to charity, and just being really strategic about when you take income to stay under those cliffs.
Now, probably the single most powerful strategy, the heavyweight champion, is what's known as the gap year Roth conversion. The logic here is beautiful.
In those years right after you retire, but before your required minimum distributions start, you're often in a lower tax bracket. That's your window. You strategically move money from a traditional IRA over to a Roth IRA. Yeah, you pay taxes on it now, but you do it on your terms, at that lower rate. And the payoff? Later in retirement, all the money you pull from that Roth is 100% tax-free. And more importantly, it's completely invisible to IRMA. It doesn't count. This one move can save you a fortune over your lifetime.
But what if you're already in retirement? What if you already got that letter in the mail hitting you with a massive IRMAA surcharge because of your income from 2 years ago? Don't despair. There is a critical escape hatch you need to know about.
You see, the Social Security Administration actually recognizes 8 specific life-changing events that they know can cause your income to drop. And look at the very first one on the list, work stoppage. You know what that is? Retirement. That's the big one. If you have one of these events, you can file a form, it's Form SSA-44, to appeal your IRMAA. You're basically raising your hand and saying, hey, my income from 2 years ago isn't my income today. They can then recalculate your premium based on your new, lower income, but you have to be the one to do it. They will not do it for you automatically.
But here's a huge word of warning. According to the Medicare Rights Center, about half of all these appeals get delayed or even denied, and it's usually because of simple paperwork mistakes. So when you file that appeal, you have got to be precise. Your documentation has to be perfect. You need to prove the event happened and prove how your income dropped. Double check, triple check, everything.
Okay, let's bring this all home. This is the most important part. Beating IRMAA isn't just a one-time trick you pull out of a hat. It's an ongoing game of strategy. It has to be a core part of your retirement plan, year in and year out.
Look at this timeline. The planning for IRMAA has to start years before you even think about signing up for Medicare. 5 years out, you're already doing those Roth conversions, building that tax-free bucket. 3 years out, you're running the numbers, projecting your retirement income to see exactly where you're going to land on those IRMAA cliffs. But pay close attention to that one right there. 2 years before you enroll, that is the critical year. That is the Super Bowl of IRMAA planning. The income you report in that 1 year sets the stage for your very first Medicare premium. You have to get that year right.
So we'll end on this thought. IMR is, it's a complicated, frustrating system, but it's not unbeatable. What it forces you to do is connect the dots, to understand that your financial decisions today have a very real, very direct impact on your expenses 2 years from now. Every move you make has that 2-year tail. So the only question left is, what's your plan going to be?